Hi students, this is the continuation of a list of financial and business terms that I presented in another video clip. Bonds. What is a bond? A bond is a security representing the debt of a company or government issuing it. When a company issues a bond, it borrows money from the bondholders. It then uses the money to invest in its operations. In exchange, the bondholder receives the principal amount back on a maturity date stated in the indenture, which is the agreement governing a bond's term. In addition, the bondholder usually has the right to receive coupons or payments on the bond's interest. Generally speaking, a bond is tradable, though some, such as saving bonds, are not. The interest rates on Treasury securities are considered a benchmark for interest rates on other debt in the United States. The higher the interest rate on a bond is, the more risky it is likely to be. Well, there are several different kinds of bonds. The most basic division is the one between corporate bonds, which are issued by private companies, and government bonds such as treasuries or municipal bonds. Other common types include callable bonds, which allow the issuer to repay the principal prior to maturity, depriving the bondholder of future coupons, and floating rate notes, which carry an interest rate that changes from time to time according to some benchmarks. Along with cash and stocks, bonds are one of the basic types of assets. Equity. Well, in the broadest sense, equity gives you ownership. If you own stock, you have equity in the firm. That is, you own a portion of the company that issued the stock, no matter how small it may be. Having equity is the opposite of owning a bond or commercial paper, which is a debt that the company must repay to you when it matures. Equity also refers to the difference between an asset's current market value, that is the amount it could be sold for, and any debt or claim against it. For example, if you own a home currently valued at $300,000 but still owe $200,000 on your mortgage, your equity in the home is $100,000. The same is true if you own stock in a margin account. The stock may be worth $50,000 in the marketplace, but if you have a loan balance of $20,000 in your margin account because you financed the purchase, your equity in the stock is $30,000. Well, this is the end of part 2 of the list of economic terms. Thanks for your kind attention. Bye-bye.